Hello, I'm Nathan Kubik, and thank you for joining us for a discussion on private equity. Hopefully, you've all had a chance to watch our broader alternatives guide video, as that touches on a number of the alternatives and goes into greater detail about interval funds and opportunities and the risks they present. But in this video, we will be diving a bit more deeply into the alternative bucket of private equity and also discuss a couple current opportunities that we find to have merit. Before starting, it's important to note that up until recently, private equity was not accessible for investors other than the most wealthy and for institutions. The minimum investors needed to deploy for a reputable manager was in the hundreds of thousands of dollars. There were also long windows of illiquidity. Now, that's not to say that those traditional GP-LP structures are not attractive. They are, and we have those strategies available as well for the appropriate clients. But for interval funds, they had not reached a critical mass and size of assets under management to provide the purity and diversification that we required to recommend to our clients. We believe this has now changed. While liquidity is still a factor, interval funds have created access for many more investors, and we are now seeing strategies that have reached the critical mass and that we believe are appropriate for inclusion in many investors' asset allocations. Similar to the public equity market, investing in private equity amounts to an ownership stake in a company, but one that is not publicly traded on an exchange. Here, we look at some broad life cycle stages of a private company. While not always the case, the earlier the stage, the more inherent risk and the more potential return if the company is successful. While we advise on seed rounds of financing and earlier stage venture capital rounds for our clients, we generally do not encourage allocations here due to the higher levels of risk associated in these stages. Instead, we focus on later stage venture capital, and even more so on the private equity stages, as they are companies that can represent a demonstrated business model that is in the growth and expansion stage of their business. At least at the moment, we are seeing opportunities in this space that appear more attractive from a risk-return standpoint for our clients. Now, in addition to the shift in access, there has also been a change in the relationship between the private and public markets. Over the last 20 years, we have witnessed a degradation of the small cap public equity markets. Historically, small cap stocks have offered greater returns, albeit with higher risk, than mid cap stocks and large cap stocks. In recent years, this has not been seen in the public stock market. The question is why? One of the answers that we would argue is that for many small cap stocks, there is no longer the incentive to go public. The historical incentive to go public was access to capital and greater valuation metrics. This is no longer the case, and we can see this impact in both of these charts. The chart on the left shows us that in the late 90s, there were around 8,000 public U.S. stocks. Today, that number is closer to 4,000. At the same time, we see the average market cap size increase meaningfully. The chart on the right shows us that for companies with greater than $100 million in revenue, there are more than 7 times as many private companies than that of public. The case we are making here is that many of the benefits for having owned small cap stocks historically has now moved to the private markets. One of the reasons for this shift is the massive amount of growth in assets that are targeted in the private equity markets. In this chart, we look at the aggregate global levels of dry powder in a given year that were set to be deployed. In 2023, there's just shy of $2.5 trillion set to be deployed by managers around the world. And this is not total assets invested in private equity, that's much higher. But that number too has grown meaningfully over this time period. Looking at the trailing 10-year performance, we can see the private equity markets offer the opportunity to outperform the public markets. There is a greater range of disparity in performance, and keep in mind that this chart considers the second and third quartile of all available managers. So there are better and worse performing managers, but this represents the middle 50%. Additionally, each underlying manager has their own niche that focuses on different sectors and stages of companies. While these are certainly compelling returns, I need to temper this with the fact that just like the public markets, short-term volatility is not focused on here, and that entry point timing is important. Thus, for our clients, we prefer a staggered entry approach, targeting specific areas in the private equity and a thoughtful deployment in terms of market cycles. Also, we look at this as an enhancement and diversifier for equities and investments with growth characteristics. After analyzing a myriad of private equity interval fund options, we have distilled our approved strategies to the Primark Private Equity Investments Fund and the BlackRock Private Investment Fund, both of which we will now dive into in more detail. Primark Capital is an interval fund that is partnered with Makita Investment Group, one of the leading consultants working with institutions who also has a specialty in the private markets. Makita's role is that of a sub-advisor to the strategy, meaning the Primark strategy will leverage Makita to source, perform due diligence, and make investment decisions within the strategy. With over $140 billion in private investment assets under advisement, Makita has a tremendous access to deal flow. Additionally, Makita offers the fund an opportunity to invest in the form of co-investments, which makes this strategy particularly interesting to us. We'll dive into that in a moment, but it is the partnership with Makita, along with the Primark stage and evolution, that makes this strategy one of the two that we are currently recommending to clients that we believe to be appropriate for. Makita advises some of our country's largest institutional investors. One area of focus is that of private equity, where they identify, perform due diligence, and advise on what they deem to be the best fund managers available for their clients. This puts Makita in a unique position that gains them access to private equity investments known as co-investment opportunities. Alternative fund managers can have a number of different fee structures, but most commonly recognized is the 2% management fee and the 20% incentive fee. To entice larger investors into their funds, and because they may not want to be the only investor in an underlying investment, they often offer their investors the opportunity to co-invest in the underlying fund investments outside of that 2 and 20 fee structure. In essence, these investors, like Makita here, have the opportunity to cherry pick underlying direct investments of the fund without the fund management or incentive fee. Recognizing this opportunity, Primark partnered with Makita to create a fund with access to these co-investment opportunities and to identify and invest in what they believe to be the best opportunities. On this slide, we take a look at how a co-investment typically works. The fund sponsor, or general partner, is the private equity fund manager. The other LPs are the underlying investors. Both groups are tied to the private equity fund, where the investments are pooled and fees are charged, generally with an incentive fee similar to the 2 and 20 structure we just discussed. Let's say the fund is investing $10 million into a portfolio company, but the portfolio company may need an additional $10 million for a total of $20 million. The fund manager may then offer a select group the opportunity to invest directly into the portfolio company outside of the fee-structured fund. Makita is in a unique position to see these co-investment opportunities and has partnered with Primark to offer a pooled co-investment opportunity interval fund. Because it is an interval fund, not all of the investments are co-investments. As we've discussed in other videos, there is still a requirement for the periodic opportunities of liquidity. I'll note, if you're not familiar with the liquidity of interval funds, please take the time to watch our alternatives video on our website, as this is a critical factor in determining whether or not interval funds are optimal for you. But let's take a look at the fund's target allocations. As you can see, the fund is targeting 80% weighting to co-investments, focused on the middle market and primarily with companies who have shown the ability to recognize recurring revenue and positive cash flow. We also see that they have a relatively diversified sector allocation with the heaviest weighting in software and services. Primark currently has about 150 million in assets under management and has been growing each month. We have been watching Primark for some time, and with the addition of Makita as the sub-advisor, along with its maturity and size, we now find it to be investable for appropriate clients. This fund has an interval structure and is formed in a 40 Act closed-end fund structure. The fund offers the opportunity for quarterly liquidity. Like all interval funds, there is a risk of illiquidity if too many investors request sales at once. The total amount that may be sold from all investors of the fund is limited to 5% of net asset value per quarter, or 20% per year, meaning that if everyone wants to get out all at once, only 5% per quarter will be available to be liquidated. While this is not expected, investors should be considering these investments with a long-term expectation in mind. There is a current minimum of $5,000. The Primark fund has an annual 1.5% fee and does not have an incentive fee. There is an additional fee of 2% if the shares are not held for more than a year. Additionally, like all private equity funds, there are fund operating expenses that are charged to the fund. The current gross expense ratio is 3.56%, which includes the 1.5% management fee. BlackRock manages our next recommended private equity strategy. And BlackRock is actually the world's largest asset manager with over $9 trillion in assets under management. They are also one of the world's leading investment managers focused in the private equity markets with over $47 billion in private equity assets under management. Recognizing the opportunity that interval funds present, BlackRock has created the BlackRock Private Investment Fund, or BPIF. The intention here is to allow accredited investors to invest alongside their institutional investors through this investment vehicle. With a long track record of success and one of the strongest names in the industry, after thoughtful due diligence, we feel BlackRock is well positioned to continue its success into the future. BPIF has a net asset value of $185 million and invests in both direct investments and secondary investments. Secondary investments occur when an existing fund's limited partner is seeking to exit the existing fund prior to its full liquidation. Additionally, general partners can utilize secondaries to provide a more dynamic set of exit options for their limited partners. In recent years, this segment has matured and offers some unique risk-return characteristics. Of course, meaningful due diligence is needed on each underlying investment, but secondary offerings can present a discounted buying opportunity, a shorter duration, and a faster return of capital. They can also sometimes offer a more likely known outcome. Similar to Primark, the majority of BPIF's investments are focused on late-stage venture capital and growth and expansion stage private equity. Primarily focused in North America, we see a relatively diversified exposure to industry sectors, with the highest weighting also being in software and services. The structure of BPIF is an interval closed-end fund that does need some additional paperwork in the form of a subscription agreement and a letter of instruction. There are also some suitability requirements as shown here. There is a 2% penalty if sold within the first year, but otherwise is available for liquidation on a quarterly basis. Like all interval funds, there is a risk of illiquidity if too many investors request the sales all at once. The total amount that may be sold from all investors of the fund is 5% of net asset value per quarter, or 20% per year. There is a current minimum investment of $25,000. BPIF has an annual 1.75% management fee and does not have an incentive fee. Additionally, like all private equity funds, there are fund operating expenses that are charged to the fund. The current gross expense ratio is 3.8%, which includes the 1.75% management fee. Now, while we believe that private equity offers attractive long-term characteristics, it's also critical to work with your advisor to examine whether or not this asset class is appropriate for you. If you haven't watched our broad alternatives video, please go to our website and under the How We Help drop-down item, click on Alternatives. There, you will see our primer on alternatives that will dive into the benefits and risks inherent in alternatives and interval strategies. Remember that every client is different, and what is the appropriate client alternative allocation can vary greatly from client to client. Additionally, there are many other factors that will play a role in determining your customized approach, and we will develop that long-term alternative investment approach with you. Thank you for your time today, and we hope this video has been helpful in beginning to understand the private equity and the role it could play in your portfolio. Take care, and please reach out to us with any questions. We look forward to speaking with you soon.